Let's talk to Clem Chambers. He's the founder of ADVFN. Very good morning to you, young Clem.
Good morning, Nick.
Right, markets, bit wobbly at the moment. What are your latest thoughts?
Well, I mean, obviously they came down, like a ton of bricks last week. I mean, we're either going to be in this sort of correction cycle that we saw in February, or it's going to crash big time. And really the call is, which is it going to be? I feel that we're going to be in a correction mode, like we were in February. It might have a little bit more to go in the UK, a little bit. Well, I think it's had its run in the US, because I think there's a strong possibility that the Fed is basically managing the markets with QE and reverse QE on the basis of a 200-day moving average. So the American markets bounced off a 200-day moving average. And so that might be the sort of, oh, whoops, I think we need to turn around reverse QE kind of line in the sand for the Fed. I could be totally wrong. It's just a speculation. If the Fed isn't there to defend this market, we're going to see a 25% crash, maybe a bit more, because the markets in America are massively high. Now, in the UK, they're not so high, nowhere near as high. I mean, we're not really much higher than we were in 2000. So whether it would also fall 25% or not is another matter. I mean, I guess really it probably would. But I think we're in a sort of a wobble zone now, and this might make a bottom. So if we're in a correction, we're kind of in and around that level right now. If it was to leg down from here, then I think, one would have to think that we might be in a really, really bad situation, that we're in for a crash. And, crashes are wonderful things if you're not in the market and you're in cash,
yeah,
and not a great thing if you don't get out. So, it's a very, very interesting moment right now. And I think people should watch the 200-day moving average in America on the Dow and other markets, because I think that is a pretty interesting, inverted commas, support level, or as I think of it, a line in the sand for the Federal Reserve. Because, I mean, no central bank wants to crash these days.
Yeah.
In the past, they would let them happen, and they'd say nothing to do with us, it's a free market, etc. But these days, they consider crashes really damaging to the whole system, and it's their job to support the system and stave off systemic damage. And of course, the Fed actually has that lever, and that lever is QE or reverse QE, and they're bringing down their balance sheet really fast and hurting lots of emerging countries. But if they start to bite themselves, they will QE, they will pump money into the market, and that money chases carry trades. And of course, some of the best carry trades are in equities. So they pull the QE button, or they reverse the reverse QE, money goes into the market, it goes into equities, up goes the market. And I think that is their strategy. And I think you can see that strategy happening between 2000 and 2002 when the NASDAQ imploded. And you can see that sideways, jagged correction market, because what they would do is try to navigate by holding the market at levels for 2 or 3 years to enable the economy to catch up with the liquidity they're pulling out. So, if the market has run ahead and is due for a 25% crash, well, at 7% a year, you hold the market roughly in a band for 3 years, and you've covered that 25% crash through economic and market growth. So I think that is probably what is going on, and therefore we are in for a series of corrections rather than a big, big crash. But that's not fate, that's just my opinion, and I'm really watching out for both.
Understood. Okay, let's have a few words about Bitcoin to wrap up. Obviously a decent move up this morning. Some key sort of chart points I've been reading about this week. What's your latest take on that?
Well, if you look at Bitcoin, it's in an ever decreasing range. So, I mean, chartists call it a flag, and there's a base in at around $6,000 a Bitcoin, and it's a thumping great support level if you're a chartist. And it kind of comes down to that level and it goes up, but when it rises, it doesn't rise quite so far. So it's kind of reaching a equilibrium point. Now, if you're a bull, you would say, well, this is the bottom of the market. Here it is. You want to be buying, and actually I am, but only small amounts. And I would buy a lot if it was to fall through this support, because if it did, it could fall quite a long way. You could see $3,000 a Bitcoin or $2,000. It could fall a long way if it was to break down. Now, I think it's quite an interesting canary in the coal mine for other assets, because, you know, if you're a rich bloke, you're going to have some Bitcoin, you're going to have some gold, you're going to have some equities, you're going to have some bonds. And, you know, Bitcoin, I think, potentially, because it's an immature asset, is potentially a good signal for which way this market is going in equities. So it's quite interesting to see it spike today. If it was to dump, I would go very, very bearish on equities. So if it suddenly broke through 6,000 and was heading to 4, I would be probably bailing out of a lot of equities on the basis that it was leading the charge.
Right.
And so, you know, if it does break to the upside, because when it breaks out these ranges, it's going to move, and it's going to move a long way. So you could easily see Bitcoin going to 8,000, 10,000 if it was to break up, and you could see it going to 2,500 if it broke down. When it breaks out of this range, which is running out of room, it's going to go, and it's going to go far. So again, we're at a turning point. If it breaks down, very, very bearish. If it breaks up, we've seen the worst of this equity correction, I think.
On that note, Clem, thought-provoking as always. Thank you very much indeed for your thoughts and your time. That's Clem Chambers, the founder of ADVFN.
Thanks very much, Nick.